stop looking at the price. Right now, if you are still staring at the silver chart today, December 31st, 2025, if you're trying to interpret what is happening by watching a red candle flicker on your screen, you are already late. Price is not the signal anymore. Price is the noise. What matters now is not what is flashing on a chart, but what has already disappeared from the vaults. What we are witnessing today is not a market correction. It is not profit-taking. It is not the end of a rally. What you're seeing is a mathematical impossibility being violently forced onto a screen to disguise a physical breakdown that has already happened. This is the final trading day of 2025, and this year will not be remembered as a normal commodity cycle. It will be remembered as the year the global financial hierarchy quietly began to invert. While the market wants you to believe silver collapsed back toward the $71 level, the physical data is screaming the exact opposite. What is unfolding right now is an extreme compression event between infinite paper claims and finite metal, and that compression does not resolve through charts. It resolves through fracture. Let's ground this in reality. In 2225, silver did not merely outperform other asset classes, it obliterated them. While gold delivered a respectable gain of roughly 66%, silver surged between 144% and 168%, depending on the physical benchmark used. That does not happen by accident. That is not speculation. That is structural repricing. Silver is no longer being treated as a secondary monetary metal. It has been reclassified de facto as a strategic industrial asset, critical, non-substitutable, and politically sensitive. And yet, on the final trading day of the year, the system attempts to paint a violent sell-off. Why? Because when mathematics turns against the system does not concede. It changes the rules. During the final week of 2025, the CME executed 2 aggressive margin hikes in just 7 days. Today, holding a single silver contract requires approximately $32,500 in initial margin. That is nearly a 60% increase in less than 1 week. This is not risk management. This is position management. The objective is clear: force smaller longs out, trigger liquidation, and relieve pressure on short positions that can no longer be defended organically. This is the same playbook used in 1980 against the Hunt brothers. When shorts cannot cover, the exchange does not change behavior, it changes the battlefield. But here's the problem. This time, the math does not allow an exit. The single biggest mistake observers are making today is focusing on futures prices while ignoring the physical lease market. Because that is where the truth leaks out. In a normal market, silver lease rates, the cost to borrow physical metal, sit between 0.35% and 0.5% annualized. That signals abundance, comfort, stability. Today, December 31st, 2025, silver lease rates exploded to 39% annualized. Read that again. 39%. That is not a tight market. That is absolute physical desperation. When someone is willing to pay 80 times the normal rate just to borrow silver, it means one thing: there is no metal left to borrow. You can manipulate a screen price. You cannot fake a lease rate. A 39% lease rate is incompatible with a $71 silver price. It is compatible with a much higher price that is not being allowed to surface. And this leads us directly to the most dangerous fracture of all: the collapse of the single global price. While New York is printing a synthetic spot price near $71, the physical market in Asia is operating in an entirely different universe. In Shanghai, physical silver is trading at premiums that convert to $76, $82, $88, even $90 per ounce, depending on immediacy. This is not noise. This is not temporary. This is a broken arbitrage. In a functioning market, a $5 to $15 spread would not survive minutes. Traders would buy in New York and sell in Shanghai until prices converged. That is not happening because the metal cannot move. Physical silver is trapped. The New York price has become local, synthetic, and defensive, designed to protect balance sheets, not to reflect reality. The Asian price has become the global floor because it represents immediate possession, not deferred promises. This divergence does not heal slowly. It resolves violently. Now look at demand, and this is where the outcome becomes irreversible. The global transition to N-type solar cells, TOPCon and HJT, is no longer optional. It has already happened. And these technologies require 20% to 50% more silver per watt than previous generations. This means that even at significantly higher prices, consumption cannot fall without shutting down multi-billion-dollar factories. Demand is structurally inelastic. The cost of silver becomes irrelevant relative to the cost of interruption. A manufacturer that consumes 10 tons per year does not stop production because silver hits $100. It pays $120, $140, whatever is required, because a halted production line is infinitely more expensive than metal input. And here is the critical detail the market refuses to price in. This silver never comes back. Solar panels are not economically recycled. The silver embedded in them is removed from the global supply chain permanently. Every installation is a buried vault. Now layer that on top of electric vehicles, fast charging infrastructure, AI data centers, and high-performance semiconductors. There is no substitute for silver's conductivity in these systems. When companies like Tesla, Apple, Nvidia, and global grid operators compete for the same finite metal, price stops being financial. It becomes strategic, which brings us to the final equation, the gold to silver ratio. Even after silver's historic rally, the ratio still sits near 58:1. Historically, when a metal enters a permanent structural deficit, that ratio collapses toward the Earth's crust ratio, roughly 15:1 to 18:1. Even a conservative adjustment to 31, assuming gold remains flat, mathematically forces silver above $125 per ounce. That is not a forecast. That is arithmetic. What you are witnessing today, this sharp drop on the final trading day, is a thin liquidity operation. Institutional desks are closed. Volume is minimal. It takes very little effort to paint a frightening candle and convince the public the peak has passed. But the physical indicators did not move. Lease rates did not fall. Asian premiums did not collapse. Industrial demand did not weaken. And at midnight, the rules change. As of January 1st, 2026, China's new export restrictions go live. Only a limited number of licensed entities will be allowed to move silver out of the country. This creates an immediate strategic bottleneck in up to 70% of the silver flow required by global technology. Combine a brutal supply choke with expanding industrial demand, and the result is not stability. It is rupture. The market already knows this. That is why metal is being vacuumed up before year end. That is why premiums are widening. That is why the paper market is in defensive mode. The price on your screen is late. Reality has already shifted. Today was not weakness. It was strength in disguise. Holding silver above $70 after aggressive margin hikes and a coordinated liquidity attack signals strong hands, not capitulation. We enter 2026 with the lowest global inventories in a decade, a major producer locking the export gate, inelastic industrial demand, a massively over-leveraged paper market, lease rates screaming scarcity. When physical metal disappears, price is no longer negotiated. It is auctioned under panic. $100 is not the target. It is the level where the market finally admits it has lost control. Those still staring at charts are looking backward. Those watching physical flow already understand the game has changed. This is no longer a promise market. It is a possession market, and the window is closing. What happens next is not gradual. It is mechanical. Once a market crosses the line where physical availability becomes conditional, behavior changes instantly. Participants stop optimizing for price and start optimizing for certainty. This is the phase the silver market has now entered. And this is where most analysts fail, because they continue to frame the situation as a bull market. This is no longer a bull market. It is a clearance event. When silver was abundant, paper instruments worked. Futures contracts, ETFs, rolling exposure, all of that functioned because nobody expected to take delivery. The system relied on one assumption, that silver would always be there later. That assumption is now broken. The moment industrial users, sovereign planners, and strategic buyers believe that future delivery is uncertain, time itself becomes risk. Rolling a contract forward is no longer neutral. It is dangerous. Standing for delivery becomes the only rational move. This is why delivery pressure is rising while trading volume becomes meaningless. High volume no longer signals liquidity. It signals stress. It means paper is changing hands rapidly because nobody wants to be the last one holding a claim when the metal is gone. This is how paper markets fail. Not through collapse, but through abandonment. Now zoom out. The silver market is not isolated. It sits at the intersection of three global forces that are all accelerating at the same time: energy transition, technological densification, and geopolitical fragmentation. Each one independently increases silver demand. Together, they create a demand profile that is non-negotiable. Solar infrastructure is no longer discretionary. Grid expansion is no longer optional. Artificial intelligence hardware does not scale without silver. Electric vehicles do not function without it. Defense systems do not substitute it. This is not speculative demand that can disappear with sentiment. This is embedded demand. Demand locked into physical systems that already exist. At the same time, supply is doing the opposite. Mining output is flat to declining. New projects face political, environmental, and capital constraints. Refining capacity is geographically concentrated. And now, cross-border mobility is being deliberately restricted. When a commodity cannot move freely, price ceases to be global. It becomes regional, political, and strategic. That is exactly what we are seeing now. The New York price reflects financial continuity. The Asian price reflects physical urgency. The Middle East price reflects clearing under stress. These prices do not converge because they no longer serve the same function. Arbitrage is not failing due to inefficiency. It is failing due to impossibility. Arbitrage requires three conditions: price discrepancy, transportability, and time. All three are now compromised. Licensing removes certainty, border controls remove transportability, inventory depletion removes time. The result is structural fragmentation, and fragmentation is not resolved by charts. It is resolved by hierarchy. In fragmented markets, the actor with the least flexibility sets the price. That actor is not the trader. It is the industrial consumer. Factories cannot wait. Power grids cannot pause. Semiconductor lines cannot hedge continuity risk with derivatives. They must buy. That is why premiums rise silently before price explodes publicly. That is why large buyers operate off-screen. That is why shortages appear suddenly rather than gradually. By the time retail participants notice, the inventory is already gone. This is also why central banks cannot fix what is coming. Liquidity can delay recognition. It cannot create atoms. When central banks inject cash, they are not solving scarcity. They are subsidizing delay. They allow balance sheets to survive longer while physical reality worsens underneath. This creates a dangerous illusion of control. Every dollar injected to stabilize paper claims increases the incentive to exit into physical assets. The more aggressively the system defends paper pricing, the faster trust erodes. This is the paradox now in motion. Support stabilizes the system short-term while accelerating its long-term failure. And that is why volatility will increase, not decrease. As physical inventory declines, price becomes less informative. Spreads widen, premiums decouple. Delivery timelines extend, allocation replaces access. At some point, the market stops quoting continuous prices altogether. It moves to episodic clearing. When metal appears, it is bid aggressively. When it disappears, price goes, no offer. That transition is not hypothetical. It has happened before in smaller commodity markets. The difference this time is scale. Silver is not a niche input. It is a backbone material. This is why the final resolution will not be tidy. Markets built on leverage resolve stress in one of two ways: repricing or restriction. When repricing threatens system stability, restriction comes first. Export controls, licensing regimes, strategic stockpiles, priority allocation. We are already watching that architecture emerge. Once that architecture is in place, paper benchmarks lose authority. They become reference points, not clearing prices. Real transactions occur elsewhere, at different numbers, under different rules. That is when narratives flip. What was dismissed as conspiracy becomes retroactively obvious. What was called manipulation is quietly admitted as policy. And what was once too expensive becomes unavailable. This is the phase where wealth transfers occur quietly, not through explosive headlines, but through access asymmetry. Those who secured metal early stop participating in price discovery. They already have what they need. Those who did not are forced to compete at the margin, bidding higher for smaller quantities under worsening conditions. This is why silver does not need hype to move higher. It needs absence. And absence is already here. The most important signal is not the price today. It is the behavior of those who no longer care about price. When buyers accept premiums without negotiation, price has lost its disciplining power. That is the end of the old regime. From here, silver does not trade like an asset. It trades like infrastructure. And infrastructure is never cheap when it is scarce. The transition is already underway. The charts will catch up later. What matters now is understanding where we are in the sequence. We are past accumulation, past denial, past warning. We are entering enforcement. And once enforcement begins, markets do not ask permission. They move.